A Random Walk Down Wall Street is a must-read for anyone interested in investing. Written by Burton Malkiel, this book demystifies the complexities of the financial world. It offers timeless advice for navigating the often turbulent waters of the stock market. First published in 1973, the book has become a classic. It has sold millions of copies worldwide. It has been updated over numerous editions to reflect changing market dynamics. The book's central premise is simple yet powerful. Stock prices are largely unpredictable. Malkiel argues that trying to time the market or pick winning stocks consistently is futile. He likens stock price movements to a random walk. This analogy suggests that trying to predict short-term market swings is as reliable as flipping a coin. Instead of chasing illusions of quick riches, Malkiel encourages readers to adopt a more rational and disciplined approach to investing. He advocates for long-term strategies that prioritize diversification and low-cost index funds. Burton Malkiel is a name synonymous with sound investing principles. A Princeton University economist, Malkiel has dedicated his life to demystifying finance for the average investor. His book, A Random Walk Down Wall Street, is a testament to his commitment to investor education. Malkiel's career extends beyond academia. He has served as a member of the President's Council of Economic Advisors. He has also held positions on the boards of major corporations. These experiences have provided him with invaluable insights into the workings of financial markets. His contributions to financial theory are significant. He is a strong proponent of the efficient market hypothesis. This theory posits that stock prices reflect all available information. It suggests that consistently outperforming the market is extremely difficult. Malkiel's investment philosophy emphasizes simplicity and discipline. He advocates for a buy-and-hold strategy using diversified portfolios. He stresses the importance of low-cost index funds as a cornerstone for long-term wealth building. Imagine a giant puzzle, constantly being solved and reshaped. That's the stock market, according to the efficient market hypothesis, or EMH. This cornerstone of financial theory argues that stock prices already reflect all available information, from company earnings to global events. Think of it like a news cycle on steroids. Any piece of information, big or small, is instantly absorbed and reflected in a stock's price. This constant flow of information makes it near impossible to consistently find undervalued stocks. Take the example of Apple. Millions of investors track its every move, analyzing product launches, earnings reports, and even rumors. With so many eyes on the prize, any new positive information is quickly priced in, leaving little room for arbitrage. The EMH doesn't claim the market is always right. It simply suggests that predicting its short-term swings is incredibly difficult. Therefore, trying to outsmart the collective wisdom of millions of investors is a losing game for most. The allure of beating the market is undeniable. We all dream of uncovering hidden gems and timing our investments perfectly. However, A Random Walk Down Wall Street argues that consistently outperforming the market is highly improbable, even for professionals. Think of it like a game of chance. In the short term, some investors might get lucky, riding a wave of market sentiment or stumbling upon a winning stock. But over the long haul, skill and luck become increasingly difficult to differentiate. The GameStop saga of 2021 is a prime example. A group of retail investors, fueled by social media frenzy, drove up the price of a struggling video game retailer. Hedge funds betting against the company faced massive losses. This event might seem like a victory for the little guy, proving that Wall Street can be outmaneuvered. However, such events are rare and often unsustainable. The GameStop bubble eventually burst, leaving many latecomers with significant losses. Section 5. Keeping it simple. Malkiel's Guide to Effective Investing. In a world of complex financial instruments and get-rich-quick schemes, Burton Malkiel offers a refreshingly simple approach to investing. His advice centers around common sense, discipline, and a long-term perspective. He believes that complexity often benefits Wall Street more than the individual investor. Malkiel advocates for a diversified portfolio of low-cost index funds. Index funds track a specific market index, like the S&P 500. They offer broad market exposure at a fraction of the cost of actively managed funds. This buy and hold strategy eliminates the need for constant trading and reduces transaction fees. It also removes the emotional element from investing, encouraging patience and a long-term outlook. Malkiel also stresses the importance of starting early and investing regularly. Compounding, often called the eighth wonder of the world, works its magic over time. The earlier you begin investing, the more time your money has to grow. Throughout history, financial markets have been plagued by periods of irrational exuberance, often leading to devastating crashes. A random walk down Wall Street cautions investors against the dangers of these speculative bubbles. The dot-com bubble of the late 1990s is a prime example. Fueled by unbridled optimism in internet companies, investors poured money into tech stocks, driving valuations to unsustainable levels. When the bubble burst in 2000, trillions of dollars in market value evaporated. The 2008 housing crisis offers another sobering lesson. Easy credit and lax lending standards led to a surge in housing prices. When the bubble burst, it triggered a global financial crisis, highlighting the interconnectedness of markets and the real economy. Malkiel reminds us that while past performance is not indicative of future results, history often rhymes. Recognizing the signs of a bubble, such as rapid price increases and a disconnect from underlying fundamentals, is crucial for protecting your investments. The investment world is often divided into two camps: active and passive investors. Active investors believe they can outperform the market by picking individual stocks or timing their trades. Passive investors, on the other hand, aim to match the market's performance through low-cost index funds. Malkiel firmly plants his flag in the passive camp. He argues that the evidence overwhelmingly favors a passive buy-and-hold approach. Studies have shown that very few active managers consistently beat the market over the long term. Active investing comes with higher fees, often eating into returns. It also requires significant time and effort to research, analyze, and manage investments. Passive investing, in contrast, offers simplicity, lower costs, and a more diversified approach. While some investors might enjoy the thrill of active trading, Malkiel's advice for most is clear: keep it simple, keep it passive, and focus on the long term. Traditional finance often portrays investors as perfectly rational beings. However, a random walk down Wall Street acknowledges the powerful influence of psychology on investment decisions. Behavioral finance explores this intersection of psychology and finance. Emotions like fear and greed can cloud judgment, leading to irrational investment decisions. For example, investors often sell during market downturns out of fear, locking in losses and missing out on potential rebounds. Herd mentality can also influence investors. When everyone is buying a particular stock or asset class, it can create a sense of FOMO, or fear of missing out, leading to speculative bubbles. Conversely, when markets decline, panic selling can exacerbate downturns. Malkiel encourages investors to be aware of these behavioral biases. He stresses the importance of sticking to a well-defined investment plan, avoiding emotional reactions to market swings, and tuning out the noise of short-term speculation. Decades after its initial publication, A Random Walk Down Wall Street remains a cornerstone of personal finance literature. Malkiel's timeless advice continues to resonate with investors of all ages and experience levels. The book's enduring relevance lies in its ability to demystify the complexities of Wall Street. It empowers individuals to take control of their financial futures. By embracing a long-term perspective, prioritizing diversification, and understanding the limitations of market timing, investors can navigate the financial world with greater confidence. Malkiel's message is not about beating the market or chasing quick riches. It's about building lasting wealth through disciplined investing, patience, and a healthy dose of skepticism towards Wall Street's often conflicting advice.